Per usual, everything on this channel is for educational purposes only and is not intended as financial advice. It is Monday. It's Macro Monday. This is going to be a bond-heavy episode. So heads up on that. Let's talk about flows for the week first. This is from CoinShares. So last week we had outflows of 55 million, mostly from Bitcoin and ETH, mostly from Canada and Germany, some outflows from the US as well. We also had some outflows from short Bitcoin. So kind of as expected, based on price, you have some people with buyer's remorse and or people who find better places to put their money in the short term. And we're going to talk all about it with the bond discussion. Some bad news for the inflation bears, I guess you'd call them. Trueflation creeping back up slowly but surely. From a TA perspective, I'd say this was it's trying to bottom out here, potentially move higher. We certainly lost the downward trajectory from energy, base effect, blah, 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 all this stuff you've heard from 10,000 people, I'm sure. So all that downward juice we had at this point, from a year-over-year perspective, is gone. And interestingly enough, we have increasing chatter about a 3% inflation target. This from Paul Krugman, the Nobel laureate, the all-knowing, all-seeing, always correct economist. The Fed has steered very clear from discussing or admitting or even talking about a 3% target. They remain focused on a 2% target, not even a range, although a range will probably be the expectation down the road. In any event, that idea is being floated, maybe because the reality is setting in that, I don't know if we can actually get to sub 2% or near 2% inflation, at least in the near term. And another thing for the Fed to worry about in the near term is some jobs data starting to loosen up a little bit. Jobs data is continuously revised, massaged, no matter who's in office. Okay, so it's not like a red or blue thing. It's just hard to know what's actually going on. But we look at the number, month over month, and it's 3.6, it's 3.5, it's historically low, blah, blah, blah. If that starts to perk up, the Fed definitely going to be taking notice. And currently, meeting probabilities are that the Fed will hold rates until May next year, just after halving. And we have no meeting this month. We have Jackson Hole, which is a economist meeting in Wyoming. And look, I kind of view this whole situation, I have this really gruesome metaphor. Okay, so warning. Imagine you're stuck between a train and a platform. Yeah, you see these headlines occasionally. Your body's in between the train and the platform, right? Below the waist or at the waist. In the moment, you're alive, you're talking. Maybe you say you're in pain. Probably you don't have any feeling in your spinal cord. But they tell you, we're going to call your family to let them know, right? They know that as soon as they move that train, it's probably all over. So that's what it kind of feels like on rates. We don't want rates to go down, because then that means, hey, it's all over. Rates come down because there have been issues historically. So right now we are in between the train and the platform, and we are just, calling our parents, calling our loved ones, calling whoever else. And maybe we stay here for 5 months, 8 months, 10 months, I don't know. But we better hope nothing bad happens to bring those rates down, because historically, as much as everybody wants a pivot has not been bullish for risk assets. And, in the meantime, we still have banks continuing to be in trouble here. This is money market funds in the gold versus bank deposits in the blue. Bank deposits continue to slowly decline and move into higher yielding instruments like money markets. This is, of course, from Jim Bianco, but unsurprisingly, if you're incentivized to move your money somewhere else, you're going to do that. And we're continuing to see that. So before we talk about bonds, let me talk about today's video sponsor, Kraken Pro. Kraken Pro is a complete overhaul of the Kraken trading experience with a one-stop shop for advanced and professional traders. Kraken Pro enables efficient trading execution across multiple markets with a UI that allows for unique optimization tailored to your trading style. You can check out Kraken Pro with the link in the description of this video. And just looking at Bitcoin quickly, Again, nothing looks too bullish here because as you'll see with this bonds, money market, it's all kind of the same word, just different duration. Bills, notes, bonds, treasuries, air quotes, risk-free yield. There's a large incentive to avoid risk assets right now. There's a large incentive to move cash into risk-off vehicles, and that's certainly hindering anything we're seeing here. So if you were bullish at 30, technicals are now bearish. Rates probably aren't going anywhere. And if rates do go somewhere, that means we're even more bearish, right? We're off the platform at that point. We're 6 feet under if rates actually go down. That's how I feel anyway. So in the moment, we're in this stasis period, and technicals are certainly bearish on that end. Like I said, Jackson Hole this week, and the theme is structural shifts in the global economy. It'll be interesting to see if we get any CBDC chatter. Last year, if you'll remember, I think it was one of the Fed chair's shortest speeches. It was 8 minutes of pure hawkishness. We'll see what we get this time around. But even though there's no meeting, the markets will certainly be paying attention to what Fed Chair Powell is saying and how he says it and what tie he wears and if he's got gel in his hair, that sort of thing. All right, bonds. Bonds are huge. They're massive. $140 trillion globally. Governments, banks, corporates, multinational, right? Most of this is government and bank issued. A decent slice of that is in reverse repo. You can think of reverse repo as just inert money that is not in the system. And when we're issuing debt, some of that came out of the reverse repo. There was some concern that as we issue our $500 billion to refill the TGA, we would see additional headwinds on risk assets. Didn't quite see that, but now that the reverse repo looks to be bottomed, if additional debt is continued to be issued, which we know it is going to be, then we of course can see that come from either risk or reverse repo, which again is just inert. If you're bullish risk, you want debt issuance to come from reverse repo. If you're bearish risk, if you're bearish Bitcoin, S&P, you want to see reverse repo actually get filled back up, okay, as we issue more debt. And the whole point of this video, why do we care? It was funny, I was looking for data on this, and Amkar from CoinDesk put out an article just today on this. Why do we care? Well, we can measure that as a correlation coefficient amongst Bitcoin price and, in this case, real yield, which is the 10-year yield minus CPI. And we currently have a very negative correlation on a monthly basis. So that's just to say, as real yields go higher, which they are, we expect lower prices based on this correlation. Very strong inverse correlation, very similar to the DXY. And he goes on to say here, gold also has a strong inverse relationship with real yields. So I do think it's important to have a viewpoint on yields here. Where are yields going? One thing to understand with bonds that's confusing. I'm a bond novice. I'm sure I'm going to butcher something. So keep that in mind. But there is an inverse relationship between interest rates and bond prices. As one falls, the other increases. In this case, currently we're having a decline in prices and a rise in yield, a rise in rates. And we had a few weeks ago, Bill Ackman come out and say that he is shorting the 30-year Treasury bond, the long bond. He believes yields could go much higher. So there are some decent bets here that long bond price-wise goes down, yield-wise goes up. And just looking at the TA for this, TLT, certainly doesn't look bullish. Trend is extremely bearish, reigniting bearish continuation recently, losing that $100 psychological support, zooming way out. It's ready for multi-year lows. And, looking at 10-year Treasury bonds, prices continuing to be negative. So that there is an expectation of yields rising. This is the 30-year yield, which the way I drew this gives me some sort of like 3D band here, but certainly out of its channel, out of its multi-year downtrend. The green highlights are recessions, US recessions. And again, from a TA perspective, it's inverse of TLT, right? It looks like it's ready for highs. It looks like it's strongly bullish. And this is going to provide additional headwinds everywhere. It's just going to bring a grinding halt to everything that isn't yield generating, like Bitcoin, like most risk assets. And even though this stuff to me, it looks like TLT is bearish, it looks like yield is bullish, as a bar chart here mentions, investors are positioned for yields to fall. So it looks as though asset managers being long, this would be the opposite of the Ackman position, but asset managers being net long to me just means there's a squeeze ready to happen, right? Just as there was probably a squeeze on Bitcoin on Friday or whatever day that was that we dropped, very quickly. This could very quickly move yields higher. And despite the record inflows, we still have yields moving higher. That's unusual, but that is the state of the game here. And the stock to bond ratio, no matter how you measure it, is just completely out of whack historically. And it just says valuations are super expensive. And ultimately, I don't want to beat the bear drum, the doomer drum, but that we're due for a correction. Sooner or later, rates will come home to roost and calm things down across the board. So look, risk-free game is where it's at right now. And we could argue about the US government eventually not being able to meet its debt obligations and having to just print more money, and that's going to be a soft default. I'm with you, but in the moment, doesn't matter. Okay, so certainly on the Bitcoin side of things, it may matter fundamentally 5-10 years from now, maybe sooner, but in the moment, it's certainly not going to help the Bitcoin narrative. Now we come to our weekly household savings, which has turned down for the first time since stimmies. So we're certainly extremely far below the historical trend at this point. And as they say, any accumulated excess savings certainly is gone at this point. And that's a problem because we have grocery prices 23% higher since COVID. According to Bloomberg, we've got households spending $700 more than they did to buy the same goods and services 2 years ago, according to Moody's. So things aren't getting any cheaper, obviously. And we have all this debt that we've saddled ourselves with collectively in the United States. And now we have delinquencies rising on auto loans and credit cards above pre-pandemic levels. So we just have a recipe for absolute disaster. And we've been talking about this for weeks, as has everybody everywhere, right? As he mentions in the tweet, all of these are at record highs. Rates, many of them at record highs. Certainly housing affordability is extremely poor. And on top of all that, we've, of course, potentially have student loan payments coming back online at the end of the month. So the consumer credit crunch continues. And on top of that, we have some more doom or bad news with China. A few weeks ago, maybe even a few months ago, everybody was all about this China reopening trade. You couldn't turn on anything on CNBC, Bloomberg, without them mentioning this China rotation reopening trade. Turns out it didn't work out. That was a terrible idea, as we know now. And on top of all that, there's a massive real estate crisis going on. And why this is an issue in China is because that's where they store most of their wealth. And if you're in the middle class in China, you're wrecked. If you're the government, you're trying to shore up problems because you know that most of the middle class stores their wealth in real estate. Now, admittedly, China's a black box as far as data is concerned. And at the end of the day, we don't always know exactly what's going on there. But I think we can discern enough from the data at this point that things may get real bad and stimmies may come back online in China here. And much like a bad penny, Evergrande, which I thought went bankrupt years ago at this point, filed for Chapter 15, which is like an international bankruptcy. $80 billion loss, $300 billion in liabilities. And if you'll remember why Evergrande at least came into the crypto consciousness for me, I'd never heard of it, but there was issues potentially with Tether holding foreign commercial paper in its reserves to back USDT in 2021, even though they said, they've never done that. I'm not going to debate whether or not I believe them, but they certainly said they've never done that. And, we had Jim Cramer going on TV saying he's worried about Evergrande related risks in Tether and crypto. I don't think it ended up mattering too much, and certainly matters less now if those attestations are real, which I think they are, in that they're holding mostly US Treasuries short dated at this point. But interesting how the Evergrande story just keeps coming back for more. And we have, New York Times, Wall Street Journal, Bloomberg, everybody's just very concerned about what's happening and what may happen, not only in China, but secondary effects related to that. And a reporter at Bloomberg broke down some of the data individually on housing declines in some of these neighborhoods. And it is brutal. So things not looking so great over in China. And we, of course, have Country Garden, which is another one recently where they couldn't pay one of their debts, 2.5 billion. And it's just, adding more and more concern to all of this. And this is coming out of SCMP, which is, communist pro-China typically most of the time from what I recall. So there's a whole lot of bad stuff coming out of China from the real estate perspective. Let's shift gears to the S&P and look at some charts at the very end here. Somebody broke down, this isn't the S&P, it's the Dow Jones, but same difference, whatever. Somebody broke down returns 3 and 6 months after the last Fed hike in inflationary periods and disinflationary periods. So I'd certainly consider this an inflationary period, and 3 and 6 months average are both negative. I think we're, we may have some disagreement on whether we're in an inflationary or disinflationary period, but I think it's pretty safe to say we've been in an inflationary period. And this may be related to recessionary lags in inflationary periods. There's all sorts of ways you can twist this and think about it, but just based on the data, again, we're in that trading platform. You know what? We're in between the train and the platform right now. That's certainly how it feels. Something else to consider when we look at S&P being up 10% or more at the end of June relative to where we are now, smack dab in the middle of sort of the doldrums, sideways expectation. Pair this with pre-election year expectations, and you can find anything you want in statistics, certainly, but this points to seasonality, suggesting just sideways from here, or a lot of noise in general. S&P has pulled back to its daily Kijun, which if you're brave and bold, you definitely want to buy. I'm just very concerned with the parabolic nature of the collapse here. Potentially, this may just head and shoulders out over the next couple weeks and return to 4,200, which at that point would be the 200-day moving average. I don't think that's out of the question at all. If I'm wrong, this could even M double top over the next couple months, but it's certainly hard for me to be bullish up here. I think the risk reward is okay based on the cloud, but certainly less bullish than I was beginning of the year. And again, there's that risk-free rate. It's the devil and the angel on your shoulder, right? The devil is risk assets. The devil is let's go long NVDA, and the angel is risk-free rate. It's right there. It's free, right? Just take it. I think that's what a lot of people are grappling with at the moment. The Qs, this is likely going to cross bearish over the next couple days by the end of the week on the cloud. 200-day moving average is quite a ways down. This may recross. This may go through the cloud. I just think there's a lot of uncertainty. And if you picked up the trend from the beginning of the year, I think as many people are now or have, they are taking profit and rotating into risk-free yield, just plain and simple. On top of all that, we have the dollar just kind of sitting here teasing us. Will she, won't she go above the cloud, the channel, the 200-day moving average? Will we get a 50, 200 bull cross here? If you're bullish crypto, you want to see this break down. You want to see this fail. You want to see weakness in the DXY. If you're bearish crypto, if you want 20K BTC, you want continued highs in DXY. You want continued highs in yield. You want the Fed to remain hawkish. You want the Fed to tease another rate raise. So depending on which side of the fence you sit there, that will hopefully inform, trading decisions in the near term. And a lot of this other stuff we're seeing toppy type behavior. Oil not quite ready for breaking down into the mid 70s, but it looks like it wants to. Head and shoulders is how I'd qualify this very early. Now, if it breaks above 81, the downside bets are off, certainly, but looks like it's a little overheated on low time frames. Gold continues to have this inverted cup and handle. Again, if it's inversely related to real yield and yields are rising, don't expect gold to do super well in the near term. Here's just one of the Magnificent Seven or whatever they're calling them. Also had head and shoulders type fractal that's well on its way to breaking down. Microsoft, Apple, Tesla, they all had terrible weeks. They're pulling up a little bit today. And I think that's why we're seeing some lift in S&P and the Qs. And of course we have NVDA, which is continuing to just buck the trend entirely and is ready by the looks of it for more highs. So I think the degens are piling into NVIDIA for as long as they can. Trend looks okay, honestly, relative to everything else. And we may get another lower high on RSI, but I don't know. It's not for me, but I can see why people would find it attractive. So in the moment, yields are extremely high relative to where they've been over the past 5-10 years. And that's going to continue to be more and more attractive and just be a vortex sucking cash wherever it can. That's all I have for this one. Like, dislike, comment, share, subscribe, and happy trading.